Bloomberg Audio Studios. Podcasts, radio, news.
Cazenove was one of the last private UK investment banks. It carried a unique mystique and really heft in the City of London. It was famously discreet. Run by former soldiers and old Etonians, Cazenove represented the grand old name of British stockbroking and corporate finance, and this era came to an end when Cazenove was fully absorbed by JP Morgan in 2009, amidst the trauma of the 2008 financial crisis. What lessons can we learn from Cazenove's story? Welcome to In the City, Bloomberg's podcast connecting you to the conversations and the stories shaping the world of finance. I'm Francine Lacqua.
And I'm David Merritt.
And this week we have with us the man who was there for it all, Robert Pickering, who was chief executive of Cazenove during the key years of change for the company as it was being slowly absorbed by JP Morgan. Over his 23 years at Cazenove, Pickering saw the City of London cement its position as a world-leading financial centre up until the 2008 financial crisis.
Yes, and he has recently published his book. It is called Blue Blood, Cazenove in the Age of Global Banking, which details his time at the bank, the dramatic overhaul and restructuring that occurred, and how the City of London transformed over his career. Robert, welcome to In the City. Just dialing it back to when you arrived at Cazenove, what was it like working there more than 2 decades ago?
Well, very different from anything you would experience today. The city generally was a very clubby, male-dominated, effectively closed shop, and that was really what was the impetus behind the Big Bang reforms of 1986. To blow that open, there was fixed commissions in the stock exchange. You couldn't have any foreign or outside ownership of stock exchange member firms. And really, it was an environment where firms barely needed to compete, let alone innovate. And the government at the time thought that this was anti-competitive, and they instituted a legal case against the stock exchange, and out went fixed commissions, out went so-called single capacity, so you had to have separation between agency brokers and market makers, and you were allowed to have external capital come into the city. And really that heralded a huge round of mergers. So all the old stock exchange firms sold themselves in that time, in the sort of 85, 86 timeframe leading up to Big Bang, to a variety of domestic and international banks, trying to form these big financial supermarkets that they thought were going to dominate the scene. Cazenove was unique in that it was the only one of the big stock exchange partnerships that refused to sell out. The senior partners at the time thought there would continue to be a demand for independent advice, which was free of the conflicts which were bound to rise in these big integrated firms. I mean, it was a pretty unreconstructed place when I joined the firm in 1985. I think I tell the story in the book. There were 35, I think, partners, of whom half were old Etonians. They were all men. All men, needless to say. And I think it was 1994, but before the firm appointed its first female partner. But again, it's quite important to understand that even though Cazenove was a bit of an outlier in that respect, it wasn't that much different from other firms of that era. So if Cazenove had no female partners, one of its competitors, like a Rowan Pitman or a Horgavet, might have one or two.
But it wasn't just all men, they were all from the same school.
Well, half of them were. Only half. And the rest of them were from a variety of other public schools. I mean, you would never run a firm like that today. And
Well, why not?
Why not? Well, because I think that if you take all your employees and all your staff from a single stratum of society, then in a connected world, you're not really likely to understand the problems of your clients or be able to advise them properly. And that's before you even get into the whole issue of whether it's right from a kind of diversity and inclusion basis, which it clearly isn't.
Your book really is about this culture clash, though, isn't it, in some ways, between the new version of banking, the global banking, the JP Morgan, which just continues to grow and sort of swallow up other smaller banks, and this more old-fashioned way of doing things to do with values and relationships. How did that fight play out over the years with you in the firm, and what survives of that? And it sort of tells the story a little bit about the City of London, doesn't it, about these cultural clashes? Well,
it does, and that's really one of the main reasons I wrote the book. I mean, some people have said they're a bit disappointed I didn't put more anecdotes about stiff collars and lace-up shoes, but I didn't want to write a book that made the firm out to be some kind of sub-Downton Abbey, P.G. Wodehouse type caricature, because it was a very serious and very successful business. And actually, its story is about the story of the development of the City of London. It went from a very small, family-controlled private partnership into being the UK investment banking business of the biggest investment bank in the world. And that whole transition took place in not much more than 10 years. Mm. So I thought that was an interesting story to tell. But the answer to your question, I mean, at the core of it, and I tried to be at pains in the book not to try to make out that the old way was somehow morally superior to the new way, because the reality is the whole business has gone the new way. And if that's the case, it's at least in part because that's the way the clients want it. But essentially the core difference is that in the old city, and it wasn't just Cazenove, it was all the old merchant banks and brokers, it was about retained relationships. So you had clients, and once you were appointed to that client, you didn't have to compete for business. If they were doing something, you would be involved. But the flip side of that was that if they wanted you to do something, you had to be there for them. You couldn't say, well, actually, no, I don't want to act for you on this transaction. I want to act for this other company because they're going to pay me a bigger fee, or they've got a bigger chance of success, or whatever. And that was the way the setup worked. Now, when the Americans came in, and it was predominantly the Americans, although there were some Europeans too, in the late 80s and into the early to mid-90s, I mean, they didn't have any clients. They didn't have any relationships. So what they did was they talked to everybody about everything. And they tried to sell as much product as they could, in modern parlance, and infiltrate, if you like, their way into the councils of these companies. And over time, they were very successful at it. But they've always maintained the freedom, and that's true even today, to the freedom of action to act for whoever they want to in a particular situation. Now, it's a slight oversimplification, but and it sounds very arcane, but actually it's a very fundamental distinction in the way the firms go about their business. And it has led, and it certainly led in our case, and it's led in other cases, to quite difficult integration programs, as the UK firms had to understand that they were playing by a slightly different set of rules.
How does the city feel to you today, culturally? Do you think this is a place that really is reflects broader British society adequately, or is there still some way to go?
And again, inevitably, my sort of starting point is what I used to know. And the thing that really strikes me now when I come to the city, which I do quite a lot, is just how, if I come into the city wearing a suit and tie, I feel completely overdressed. And as recently,
you got the suit though. It was the tie.
It was a pandemic thing.
Yeah. No one's wearing a tie.
If I wouldn't have, even 5 years ago, I would not have dreamt of coming into the city not wearing a suit and tie. And I was walking, I guess it was in 2021. I was walking down London Wall. It was a warmish day, and there was a guy walking down London Wall, and he was wearing a sleeveless kind of vest, Speedos and flip-flops. And I thought, hang on a minute, something's changed. Something has changed. Yeah, he's probably chief executive. And, I mean, there's always more to do on these things, always. But it's easy to take for granted the progress that's been made. If you walk around the City of London today, it is, even compared with 5 or 10 years ago, it's completely different. It looks and feels completely different. And I think it's partly a reflection of the fact that the ecosystem is just so much more varied. There are so many more different kinds of firms, employ different types of people. So many of them are truly meritocratic in trading businesses. They don't care where you went to school. They're not interested. All they want to know is, can you do the job? Can you generate revenue?
And is that the influence of the American influx? It's the dominance of places like JP Morgan now around the City of London that have forced that kind of change, haven't they? Or do you think that the Cazenoves or the legacy British companies have been part of that dynamic?
I don't think it would ever have been the case that anyone would have gone to work at Cazenove wearing Speedos, but I think that we inevitably would have developed. I don't think it's just the American, but I just think it's the internationalization of business. It's not just America. People from all over the world working here now.
Richard, is that good or bad? Because I can't tell by hearing you speak whether the City of London has actually lost something that maybe was a differentiating factor in financial services.
Well, I mean, there's a whole different discussion about why the City of London's position potentially has eroded, but I don't think it's got anything to do with the diversification and kind of fragmentation of the city in that respect. It's an interesting one, Francine, because if I look back in the 80s, being at Cazenove and being a Cazenove partner, it was fantastic, but it's gone. There's no point in dwelling on it or saying it's a shame or we should turn the clock back to how it used to be. And as I alluded to, there are lots of aspects of the firm which you wouldn't possibly go with today. So I try not to think of it that way. I mean, the whole client ethos, the whole alignment of interests that came with the old partnerships, I think was a very good thing. I think it served the clients very well. But again, it's history, and I don't think there's much point in lamenting it.
Robert, Deutsche Bank is doing a similar move with Numis.
Yeah.
What did you think when you saw the news?
Numis had built a very good business, and they had some very good people there. But the problem is when you have a deal drought, as you have at the moment, particularly in M&A and IPOs, these firms are almost completely reliant on M&A and IPOs. They have a secondary market broking business. But to be honest, that's kind of a break-even business over the cycle. So if there are no deals, then your profitability is hugely impacted and very quickly. And I mean, this is what happened to Cazenove in the very early noughties. And it's a very uncomfortable feeling. And funnily enough, it's not uncomfortable so much because you think, oh gosh, we're not going to make any profit, although obviously that's not great either. And Cazenove was private at that point, whereas Numis had gone public, so clearly they had obligations to shareholders. The big problem, I think, is that they feel, oh God, we can't pay our people because we haven't any profits, and we're all going to lose all our people. It's very easy to lose your nerve. Now, these things are cyclical. It'll come back. We don't know quite when, but it will come back. IPOs will come back. M&A will come back. And again, profitability can be restored very quickly. But particularly if you're in the public markets, if you're looking ahead and there's no visibility on a pipeline and you've got no profits and your share price is going down and someone comes along and says, we'll give you a 50% premium or whatever it was, it's quite a difficult thing to turn it down.
Do you believe that the IPO drought in London is cyclical, or is there something more worrying going on with the London market, the flow of deals over the Atlantic? Do you see that reversing?
I think it'll be cyclical to some degree, no question about it. But there's obviously something more fundamental going on. There's a sort of zeitgeist thing as well, I think. And by which I mean that it's become the thing to talk about. But the reality is, I think the decline of London's position is a result of well-intentioned but ultimately ill-thought-out regulatory change. So we've all talked about the changes to the pension fund regulations, which has meant largely the withdrawal of pension funds from the equity markets, the decline of the size of the London market. You had changes to the regulations surrounding equity research, which meant that the economics of that were fundamentally undermined. So you got fewer analysts.
That was the MiFID.
Yeah,
that was the European-wide. Yeah.
So you got fewer analysts. And most of the analysts that are around, particularly in the small and mid-cap area, are generalists. So there isn't a great store of deep knowledge in a lot of sectors, particularly technology, because there haven't been that many technology IPOs or not many listed technology companies in this country. So it all adds up to a valuation gap and a feeling on the part of management that there's a kind of risk-averse and overly price-sensitive investor culture. And there isn't a great deep well of knowledge about their business. And they feel that those aspects are going to be more available in the US market. I think the listing rules at the margin probably don't help, although I frankly don't think that's a huge thing. I think the governance is definitely an issue for people floating in London. I hate to say it, but I think the whole pay thing is an issue.
No, people aren't paid enough.
Well, no, see, but this is why it's a difficult subject, because you can elide the pay as an issue to saying people aren't paid enough. Now, clearly, there's been huge pay inflation in chief executives and senior management of listed companies over the last 20, 30 years. And it's perfectly reasonable to be skeptical in certain sectors when someone who's running a largely domestic business says, I need to be paid the same as someone who's doing the same job in New York or wherever. But the reality is there are businesses where the market for management talent is global. I've had experience of this myself, sitting on the board of a FTSE 100 company and trying to recruit a CEO, and it's extremely difficult. You have just a lot of rules that make it very difficult to pay people competitively. And these people are mobile. They don't owe us a living, and they can work anywhere. So that definitely is an issue, I think, for anyone thinking to list in London.
So, Robert, does it mean that actually there's no place for a small investment bank or a boutique investment bank right now because of the rules and regulation?
No, I don't think that at all. I mean, I think it depends on their business mix. If you look at the ecosystem in London, it's very interesting because you have the big investment banks, and the Americans have won the game, and that's fine. And the biggest companies go to them. You've got the sort of super boutiques, the kind of Centerviews or the Evercores. I mean, Greenhill sold out to the Japanese, but so you've got those, which are now really quite big firms in their own right and doing different things. You've got people like Simon Roby doing his thing with Roby Warshaw extremely successfully. And then you've got the smaller brokers. As I say, the problem for the smaller brokers is that they're saddled with all the costs of being in the equities business, all the technology, the analysts, the international footprint, and all this kind of stuff. But their deal flow is primarily domestic. So when that disappears, as I say, their profitability is shot to pieces. So At that point, they either have to try to merge with someone, or they sell out, or they just make sure they're well capitalized enough that they can hunker down and weather the storm. But as I say, it's easy as a commentator to say that, but when you're in the middle of it, it feels very uncomfortable.
When you look around Europe, do you see any other rival financial centres to London emerging? There's endless debate about Paris, Frankfurt. Paris seems to have been attracting the lion's share, at least of kind of the Wall Street banks in terms of investment post-Brexit. But that argument seems to have faded a little bit of late. I mean, do you think the city is kind of consolidating its position more?
Well,
and getting used to Brexit, I suppose.
It's hard to say. And, as you say, there was a lot of sort of catastrophizing after Brexit about how, and fewer jobs went. I'm not sure how much comfort to take from that. I mean, again, 20 years ago, people used to talk about, every time there was a hiccup, they'd say, oh, everyone's going to leave and go to Frankfurt. And everyone would say, really? Yeah, everyone's going to leave and go to Frankfurt. All these old Etonians are going to go to Frankfurt. I don't think so. But nowadays, the workforce in the city is much more international. It's much more polyglot. I mean, I wouldn't mind a couple of years in Paris. I don't know about
Frankfurt?
Maybe.
I'm not a Frankfurt girl.
You could cycle to work.
It's a very livable city, Frankfurt.
But, even if you look further afield, I mean, you look at places like, Dubai and Singapore, a lot of people going up there. It's pretty attractive. You go out there, work for 2 or 3 years, don't pay any tax.
So maybe someone like Dubai is maybe more of a pertinent question, which seems to be booming on so many levels. There's tax questions as well. Capital markets are, should we be looking, we should be not so worried about Paris. We should be worried about the Middle East in terms of student.
Well, worried. I'm not sure worried is the way I'd put it, but I think there's I think the prospect of fragmentation of people living in different countries, particularly if you've got Nick Candy on your podcast saying how undervalued property is in Dubai, is much more real than it was 20 or so years ago.
Robert Cazenove also advised the government on a lot of its privatization campaigns in the 80s. There's talk now about privatizing less or even bring them back into the government fold. What lessons did you learn back then that could be applied now?
It was a very disparate group of firms that were privatized through the 80s and into the early 90s. I think if you look at it now, you'd probably say that the very early ones worked out reasonably well, kind of macro standpoint, in the sense that they were probably businesses that were better off in the private sector. I think later on, the barrel got scraped a bit more. And some of the businesses which were either natural monopolies probably weren't suitable candidates for privatization. I think we can all have our views about the water companies and the electricity companies. And I think one of the things that caused problems at the time was that you had management that effectively had grown up as quasi-civil servants, suddenly put into the private sector, given very substantial pay increases, and then incentivized to go out and grow their non-regulated earnings. So there was a huge splurge of acquisitions, many of which were value destroying. But it's interesting because you obviously have talk at the moment about a potential retail offer at NatWest. And there's a sort of retro feel to that, isn't there, about back to the big campaigns of the past. And despite the number of privatizations and the fact that they were sort of priced to go, so people generally in the short term made money on them. I don't know if you remember the term stagging. Stagging was where you would, put multiple applications in and sell them on the first day of dealings after the price had gone up. But I mean, this sort of shareholding democracy idea never really took hold, and people are talking about it a little bit more at the moment. And I think the trouble is it's always from the point of view of the issuer or the government. There's less talk about the small shareholder and the investor. And I think you have to think to yourself, is it really the right thing to incentivize a small shareholder who may not have a lot of money to put money into a single stock bank, which they almost certainly won't understand? I mean, by and large, the people who run banks don't really understand the risks they're running. So the small shareholder certainly isn't going to. And so there's a sort of slight ethical dilemma there in my mind as well.
But haven't we got to encourage more or wider? I mean, I remember that British gas campaign in the 80s, and it did encourage, didn't it, some broader engagement with the idea of owning equities. And I think to your point about some of the problems we've got in terms of the London market, if we had more people interested in owning shares, that would help, wouldn't it?
Well, possibly at the margin, although the big shareholder, the big pools of money are the pension funds, and the pension funds, as you know, their share of equities, let alone UK equities, is vanishingly small. I can see that you could tweak the rules to adjust that. But I think if you were advising a friend or a relative who was not particularly affluent, you wouldn't say, well, why don't you buy some shares in NatWest or Barclays or whatever? You might say, put your money into a well-managed active fund, Linsell Train or Terry Smith or something, or stick it into an ETF, diversification, all that kind of stuff, you would actually probably be trying to persuade them not to take on single stock risk. So I think we have to think about that aspect of it at least as much as the benefits, so-called benefits to UK PLC.
Thank you so much, Robert.
It's been a pleasure. Thank you for having me on.
Thank you. Thanks for listening to This Week's in the City. We'll be back next week. But in the meantime, if you like our show, please head on over to wherever you listen to podcasts and rate, review, and subscribe. It helps people find the show.
This episode was hosted by me, Francine Lacqua, with David Merritt.
It was produced by Summer Sadi and Tiffany Choi, with additional editing by Blake Maples.
Special thanks to Robert Pickering.